All right, so now for the fourth section, the contract phase and actually buying your home. It's where it gets fun. All right, so first you make an offer. When you find a home you want, decide on the price you want to pay, you or your agent are going to call me or request a specific pre-qual letter for that property. You just text, email, or call me for the address with the price. I then share that with you, and then after your agent submits the offer, I can let the sellers know you're well qualified and we'll make it to closing proactively. Now, this is where you and your agent decide if you want to put in contingencies, ask seller for assistance on the closing costs, determine your earnest money deposit. Now, what are the contingencies that I just mentioned? Right, these help you get out of the contract with your deposit back if something goes wrong. There's three main ones. The first is the home inspection. For this, your agent will have a licensed inspector, water heater, HVAC, roof, make sure things are running correctly. If something's bad, you can negotiate with the sellers to fix it in the middle of the contract phase or get out of it. The second is the appraisal. This will check for structural functionality and the value of your house. And then the third contingency is the financing approval. It's not like I'd ever leave you hanging and tell you you could close before going under contract and then later get denied. However, it's common to have. Now, if you waive all these contingencies and go in without these safety nets, it means you're probably in a very competitive situation and you want to beat out other bidders. But these are the contingencies, and there's even a few other minor ones. Now, here's what happens from going under contract to closing day. This could be as little as 10 days, but it's usually about a month. Right when you get the contract, you have the busiest 48 hours of the process. You pay your earnest money deposit, you lock your rate, you e-sign your initial disclosures, you pay for your appraisal, send in any outstanding documents. After a week or so, your appraisal, home inspection, and financing approvals likely will be in by then. And then after that, third-party approvals such as title work, insurance, verifications of employment come in. Then a few days or less before closing, you get your final clear to close milestone. This means all items, conditions, approvals, third-party work is in. And then once you're cleared, you get your final dollar amount that you have to bring to the title company as a wire or cashier's check. And that's when you go to your bank to get the money. Bring it to the signing location, and then you sign your final documents. And at that point, the title company disperses the money from your check and all the other money coming in and out throughout all the different parties, yourself, the bank, whoever, to all the other parties owed. The seller, the old lender, insurance companies, third parties charging closing costs. Now, once you go under contract, this is the first time that you can lock your rate for the duration of the loan. You don't have to do this on day one, but most often people do. When you lock, you can always exchange interest rate for closing costs. What I mean by that is you can increase your interest rate to decrease your closing costs, or vice versa. You can decrease your rate by paying more closing costs, also known as points. Whatever trade-off feels more comfortable to you, you're free to take, should you still qualify for the higher payment or closing costs. In addition, sometimes you may have the option to choose an adjustable rate mortgage loan in addition to taking a 30-year fixed rate loan. Adjustables can be rare, but in theory, they can come with an introductory rate for several years that would be lower than the 30-year fixed interest rate. But after the intro low rate expires, the rate then floats to match whatever market offers at that time. When the appraisal comes in, it will then affect the contract if it comes in below the sale price. So if it comes in at the sale price, everything stays the same. If the appraisal is above the contract price, also nothing happens. You basically get free equity and don't have to tell the sellers. But in the third scenario, if it comes in low, you have three options. Number one, renegotiate with the sellers to bring the price down. Number two, restructure the loan. Or three, exit the contract if you have an appraisal contingency. Now, if the sellers won't agree to lower your price, then the lender may require you to lower the loan amount and bring a larger down payment. Your mortgage insurance, interest rate, payment, APR, all can possibly increase here. But low appraisals may not even lead to any of this. Your loan still may be fine if you have enough equity, but that's something that you would also want to talk to me about offline. Now, there is also a possibility of the appraisal being waived altogether. It's always a case-by-case scenario based on nearby similar properties' values. You usually need at least 20% down on an owner-occupied home for it to be even possible. It would have to be a conventional or conforming loan. You couldn't do this on an FHA, VA, or jumbo loan.